Let's discover how to conquer inflation in 2023 and 2024 based on the knowledge of Warren Buffett. Be sure to watch the full video to safeguard yourself against the next inflation wave and know exactly how to grow your money exponentially. Let's start with Layer 1, Cash. Allow me to introduce to you George, a seasoned man in his 50s, bravely navigating the hard maze of inflation. George had a grand plan, or so he thought, with his hard-earned dollars snugly tucked away. But as the curtain rose on this comedic tale, he was in for a surprise twist. George believed his money was secure, lounging in the cozy confines of his bank account, a strategy that seemed ingenious. Little did he suspect that inflation was lurking around the corner, poised to stage his magic spectacle. Suddenly, his dollars began to lose their luster, evaporating faster than spilled water under the sun. It was as if he had stumbled upon a magician who had forgotten how to perform the trick right. The disappearing act was on, and George found himself staring at his savings, envisioning them as a hand of cards in the game of Old Maid. Just like that undesirable card, George's dollars seemed destined to lead him astray. Make sure to watch till the end to discover how George turned his financial mistakes around and reached financial freedom thanks to implementing the investing knowledge you are about to learn. This is what you should know about the world of money and investing during times of inflation. Holding on to cash is like watching your dollars disappear into thin air. It's not just Warren Buffett who thinks so. Another big-shot billionaire, Ray Dalio, put it in a catchy way. Cash is trash. Why? Well, when prices are going up, the cash you keep in your piggy bank or under your mattress loses value. How much cash do you currently hold? While it's essential to have protection for a rainy day, make sure to always keep a minimum amount of money in cash and invest the rest. This way, your money can work for you instead of against you. Here's the secret sauce you need to know. Think in real terms. Imagine your cash earning a cool 10% return in a year. Sounds fantastic, right? But hold on tight, because there's a plot twist. It all depends on the inflation rate, the tricky character in this financial drama. If inflation is running high at, say, 7%, and your interest that year gave you 10%, the real story isn't as thrilling. Your real return, the one that counts, is only 3%. Yep, you heard that right. 3%. Not quite the jackpot you were hoping for, huh? And that's why cash finds itself at the bottom of the pecking order. When you hold on to cash during inflation, it's like your money's hitting pause on growth. Your return on cash? Basically zero. And when you stash cash away for the long haul, inflation sneakily chips away at it. It's like a silent financial ninja working against you. So here's the big takeaway. As an investor and somebody who's got money etiquette down, you've got to keep your eye on the real deal. Cash might feel comfy and cozy, but in an inflation showdown, it's like bringing a butter knife to a sword fight. To grow your wealth and stay ahead in this financial adventure, you'll need more than just cash in your corner. That brings us to Layer 2, Fixed-Rate Bonds. Above cash on the hierarchy are fixed-rate bonds. George's trusty fixed-rate bonds turned out to be less dependable than he had banked on. The once enticing returns now seemed as substantial as a soap bubble in the wind. These bonds are often considered super safe in the world of traditional investing. But here's the plot twist. Warren Buffett has a problem with these so-called safe bets, and it all boils down to the same sneaky troublemaker called inflation. Do you currently own fixed-rate bonds, or are you planning to invest in them? Well, now might be the perfect time to reconsider your plans. Imagine this. The current yield on a 10-year U.S. government bond hovers at a modest 1.8%, a number that may seem reassuring. So, if you were to jump on board and snag one of these 10-year government bonds today, you'd essentially be locking in an annual return of 1.8% for the next 10 years. But here's where the excitement kicks in. Or, well, I should say, here's where the trouble kicks in. Let's meet our strong enemy once more, inflation. If it decides to hang around at an average of 4% per year over the next decade, which isn't a wild stretch considering recent history clocked inflation at a whopping 7%, your annual real return takes a nosedive, plunging into negative territory at negative 2.2%. Yes, you heard that right. Your money is actually losing its value when you account for the impact of inflation. Are you still in love with fixed-rate bonds after hearing this? I don't hope so. Now, don't get me wrong, it's an improvement compared to plain old cash. But, and it's a big but, it's still a far cry from the holy grail of investment returns. Fixed-rate bonds might not be the superheroes they're cracked up to be, at least when it comes to battling inflation. So when you're navigating the investment landscape, remember this tale of bonds, inflation, and the quest for returns that truly matter. Let's switch up gears and move on to the next layer of our investment pyramid, which is Layer 3, Unproductive Assets. Consider George to be the guy who grips his flip phone like it's a priceless treasure and insists that music peaked back in the day. George, with his quirky wisdom, was the kind of fellow who always had an interesting take on life's financial quirks. You see, George was quite the art aficionado. A prized painting adorned his living room wall, standing as his ultimate investment, a fortress for safeguarding his wealth. And let's not forget about those glistening gold coins he secretly squirreled away, convinced they held the key to his financial triumph. George had his plan, his strategy, but then inflation decided to have a little fun. So how did George tackle this conundrum? As inflation did its merry dance, George had an epiphany. His treasured artwork in gleaming gold were just static, unyielding entities. Despite all his nostalgia, they weren't exactly turbocharging his purchasing power. He realized he couldn't emulate a dragon guarding its treasure and expect the world to bow at his feet. This realization had a hint of sarcasm, and George quipped, "Well, there goes my notion that art and gold were like magic spells." George embarked on a quest for alternatives, which you will soon discover in the upcoming layers. Let me give you a bonus tip. Subscribe to Investing 101 for investing stories that will actually help you achieve your financial success. Jay, Diablo, Jeffrey, Adonis, and many others achieved financial success, and you're the next one on the list to do so. And don't forget to leave a like and share this video with your close ones to help them too. Now, let's get back to unproductive assets. Unproductive assets, including gold, silver, and other precious metals, may not churn out cash, but they've got a certain allure when inflation comes knocking. During inflationary times, these precious metals can act as a hedge, a shield against the ravages of rising prices. You see, they have this unique quality. They tend to hold their value when everything else appears to be in chaos. Which percentage of your investment portfolio is currently invested in unproductive assets? While unproductive assets can play defense against inflation, they might not be the superstar you're looking for to catapult your wealth into the stratosphere. They have their limitations, despite appearing attractive. They won't generate dividends like a stock or harvest crops like farmland. Since we're smart investors, we don't just want to keep up with inflation. We want investments that can outperform inflation and that produce a real return for us. That brings us to Layer 4, Productive Assets. George was no stranger to life's up and downs. He had seen his fair share of challenges. But as he reached his mid-50s, a new concern loomed on the horizon, something he hadn't given much thought to before inflation. George had always been prudent with his finances. He had a modest savings account, a collection of antique teapots, and a little nest egg set aside for a rainy day. He often heard people talking about the importance of maintaining the value of assets during times of inflation. As he pondered these conversations, he realized that he needed to take action to secure his financial future. With a newfound determination, George set out to understand the intricacies of asset preservation in an inflationary environment. He dove into books, articles, and online resources. Armed with a growing knowledge, he decided to start by assessing his current assets. George's prized possession was his collection of antique teapots. He had acquired them over the years, convinced that their historical significance would make them an excellent store of value. However, as he dug deeper, he began to see the flaw in his plan. While the teapots indeed held their value, they weren't generating any additional income. They were like stationary sentinels, guarding their worth without contributing to his financial growth. This realization hit George like a splash of cold water. He chuckled to himself, acknowledging the irony that something so traditional and seemingly valuable could fall short in the face of changing financial dynamics. Undeterred, George decided to explore other avenues. A close friend of his, a shrewd investor named Robert, had often extolled the virtues of productive assets. These were the type of assets that didn't just retain their value, but generated income over time. George thought back to the stories Robert had shared about Warren Buffett, the renowned investor, and his preference for investing in productive ventures like stocks and businesses. George realized that he needed to take a page out of Robert's book. He needed to find productive assets that could weather the storm of inflation and even flourish in its wake. He chuckled as he thought about his friend's advice, remembering the time Robert had quipped, "Inflation is like a storm. You can either get swept away by it or learn to ride its waves." Taking this advice to heart, George set out on a quest to identify businesses that could thrive in an inflationary environment. He remembered the tale of Johnny, a young entrepreneur who had managed to navigate the challenges of inflation in a rather unexpected way. Johnny, a high school student with an entrepreneurial spirit, had started selling chewing gum at his school. It seemed like a small venture, but it held a valuable lesson for George. Johnny's strategy was simple. He purchased gum at the beginning of the year, sold it to his peers, and reinvested the profits to buy more gum for the following year. George laughed at the cleverness of it all. Johnny wasn't just selling gum. He was creating a self-sustaining cycle of income. But here's where the inflation twist came in. As prices rose due to inflation, the cost of Johnny's gum also increased. Yet because Johnny was selling the gum at a markup, he could adapt to the changing prices and continue reinvesting his profit. Here's another example of a business type, but one that you should avoid. Businesses that are like thirsty plants in need of constant watering. And by watering, I mean cash. These businesses guzzle money to keep the wheels turning. Sadly, during inflation, they often find themselves in a tight spot. While their earnings might go up a bit over time, they end up pouring more and more dollars back into the business just to stay afloat. Imagine treading water, and every stroke you take forward, current pushes you back. It's not the kind of business dance you want to be part of. Let's break this down with a real-world example: United Rentals. They're the big dogs in the equipment rental game, dealing in everything from bulldozers to portable restrooms. United Rentals buys this gear and rents it out to construction projects for the short term. It's a straightforward business, but here's the catch. The equipment isn't immortal. After a few years, it needs replacing. For the sake of simplicity, let's say each bulldozer costs a cool $1 million. Over its lifetime, it rakes in $1.2 million in sales, making a sweet profit of $200,000. But here's where things get dicey. Inflation hits. Let's say it's a hefty 20%. So when it's time to buy a new bulldozer, it's not $1 million anymore. It's a whopping $1.2 million. That profit you made? Well, it's gone right back into replacing that bulldozer. The business is stuck in a loop where every penny earned goes right back into the same spot. It's like running on a treadmill. You're putting in all this effort, but you're not getting anywhere. Now, I don't expect inflation to ever be as wild as 20%. Fingers crossed. And United Rentals is a solid company, but this example shows the struggle that capital-intensive businesses face when inflation comes knocking. It's a challenge, to say the least. Before we continue with George's story, make sure to subscribe to Investing 101 so that we can help you on your road to financial freedom. Back to George. George saw parallels between Johnny's gum business United Rentals, and the concept of productive assets. He realized that he needed to find businesses that could do more than just survive inflation. They needed to thrive despite it. He continued his research, seeking out businesses that had pricing power, the ability to adjust their prices in response to inflation. This led him to an insightful understanding of businesses that were less susceptible to the negative impacts of inflation. George learned that companies with solid pricing power could pass on increased costs to their customers, ensuring their profit margins remained intact. It was like a dance, a rhythm of adjusting prices to stay in step with the changing economic landscape. As George's knowledge deepened, he encountered stories from history that further illuminated his path. He recalled the crisis faced by savings and loan associations during the 1980s and 1990s. These institutions held a significant amount of cash and bonds, which were highly vulnerable to the erosive effects of inflation. It was a cautionary tale that underscored the importance of asset allocation. With newfound wisdom, George began to make changes to his investment portfolio. He divested from assets that lacked the potential to grow in value and shifted his focus towards businesses with solid pricing power. He diversified his investments, ensuring that he had a mix of assets that could weather inflation storms. George's journey was one of transformation. He had moved from a place of uncertainty to one of strategic insight. As he took each step, he couldn't help but chuckle at the irony of his misconceptions. The antique teapots, once seen as stalwart protectors of value, now appeared as mere relics compared to the dynamic potential of productive assets. George's conversations with his friend Robert took on a new flavor. They exchanged stories and insights, sharing a camaraderie fueled by a common goal: to navigate the complexities of finance with wit and wisdom. George realized that he was not alone on this journey. Others were grappling with the same challenges, and there was a wealth of knowledge to tap into. Over time, George's efforts began to bear fruit. The convenience store he had invested in adapted to changing prices, and its revenue grew as a result. He chuckled as he thought about how the store was like Johnny's gum business, adjusting its prices to stay afloat amidst the currents of inflation. As George watched his investments flourish, he also saw a change within himself. He had become more financially savvy, more attuned to the nuances of the economic landscape. He was no longer a passive observer. He was an active participant in shaping his financial future. And so, George's story unfolded. A tale of learning, adaptation, and a touch of humor. As he sat back sipping tea from one of his antique teacups, he marveled at the journey he had undertaken. It was a journey that had led him from misconceptions to insights, from uncertainty to confidence. In a world where inflation could be as unpredictable as the weather, George learned to be a savvy sailor. He learned that while unproductive assets might hold their ground, it was the productive ones that could carry him forward. If an average man in his 50s like George can achieve financial prosperity, then you and I can as well. In the upcoming video, you'll discover the required steps on how to quickly reach your first $100,000 based on the knowledge of Charlie Munger, Warren Buffett's business partner.